see the slide.
Good evening. Good evening to everyone. I'd like to welcome everyone to the presentation tonight on behalf of the Lohana Professional Network, which is part of the Lohana Community of United Kingdom. Today's presentation is on wills, probate, and inheritance tax. We all know this is no Love Island or Ye Rishta Kya Kehlata Hai, but as Benjamin Franklin once said, in this world, nothing can be said to be certain except death and taxes. So today's presentation hopefully will be food for thought for those of you who want to pass on your assets and as per your wishes, and also structure your estate in a more tax efficient manner. The plan for this evening is shortly Mr. Sunil Majitia, who is the president of Lohana Community UK, will say a few words and introduce the speakers, who will then lead the presentation. After the presentation, given time, we'll have a Q&A session for about 10 to 15 minutes. So if you have any questions, please post them in the comment section of the Facebook page and we will pick them up from there. Thank you. Can I request Mr. Sunil Majitia to now come forward, please?
Good evening, everyone, and a warm welcome. Lohana Professional Network is a Lohana Community of United Kingdom body, which was set up to bring like-minded professionals together to share ideas and network. Tonight is the fourth talk we are holding, and the subject is, as Bharat mentioned, wills, probate, and inheritance tax. For this, we have tonight high-caliber speakers who are experts on this field and come from a very reputable organization, PwC UK. We have two young ladies, Claire Stirzaker and Alison Hill. Claire is a partner and a solicitor at PwC UK, heading up their private client legal business. She advises private clients and private offices on a wide range of legal, governance, and tax matters with a particular focus on succession planning. As a result, she primarily advises on wills, trusts, and other succession planning tools. Claire also supports families in drafting family constitutions, setting up family committees, helping with the design and implementation of family office structures, and leading next generation training to further implement succession plans. Claire is viewed as one of the leading private client advisors in the UK and has won numerous private client prizes with bodies such as STEP and City Wealth, and was recently listed as EP Private Clients Top 50 Most Influential Private Client Advisors 2020. We also have Alison Hill. Alison is a partner in PwC International Private Clients team with more than 20 years of experience advising high net worth international families, their businesses, and their trust structures. She works closely with a number of family offices, providing UK tax advice and liaising with the International Tax Network to bring a global service where required. Alison also has extensive experience of working with institutions providing services to such individuals, helping them to ensure that the services they are providing are appropriate to their clients' requirements from a UK tax perspective. I'm very grateful to Claire and Alison to give up their valuable time to impart their knowledge on tonight's subject, and of course PwC to allow them to do so. I hope you all find this evening's session very valuable and ask lots of questions to our speakers. So without further ado, I'll now hand you over to Claire and Alison.
Thank you so much, Sunil, and thank you for such a lovely introduction to us, not least because you called me young, which was great. I don't feel so young at the moment, so I'm just going to share my screen with everyone here so we can go through some slides. So thank you very much, everyone, for joining us tonight. We arranged this event a few weeks ago, and obviously we had no idea that there'll be the COVID announcements that there were today. So well done, firstly, to those of you who've managed to dial in on the back of some quite depressing news today, and particularly when it's about a topic which, you know, is probably very relevant right now with COVID on the increase. And so it's not an easy topic to discuss. And I think it's great that people have dialed in to listen to this, to think about this quite pragmatically and properly. So hopefully we can give you some really good food for thought about what to do here. And obviously we're available for questions at the end. So just a couple of minutes just on us as a firm. I mean, I think people obviously know PwC, I'm sure it's one of the big four accountancy firms, but what people don't appreciate is it's a very, very broad and diverse consultancy practice, and our private business practice is a huge part of that overall. So Alison and I, as Sunil mentioned, sit within our private client practice, which is a national practice in the UK. We've got offices in many different locations across the UK and in Scotland, but we also have an international network of private client offices. So it's a long-standing part of PwC. We sit within what we call our private business practice as well. So we've structured it that way because most of our private clients will be the owners of really successful businesses, and they want to work with advisory teams that understand both their corporate and their personal needs, and even more, that understand how the two mesh together. So we're very focused as a group on how we can support private business owners. We've got a passion for private business sector, and we recognise that you have many challenges to face, both with your business and with your family, when it's a family-owned business in particular. And so we want to make sure we can help with both sides. So we really look at how we can help you manage ownership and manage business. And clearly, Alison and I have a real focus on ownership in particular. So tonight we're going to talk about wills, a little bit on probate, and obviously inheritance tax. You know, as I said a few minutes ago, before COVID, when I was advising clients on this area, we tended to have some really good, deep and broad discussions before we got into the nuts and bolts of a will and inheritance tax, around thinking through, how do I best pass wealth on to my children? You know, if I'm passing wealth on to family members, how do I do that fairly? How can I keep some control over what I may give away during my lifetime, and so on? So some good questions there that we spent some time working on with families. I think with the impact of COVID, you know, all of us across the private client industry saw a marked increase in inquiries from clients looking for help with their estate planning. I think the Law Society reported there was a 70% increase in inquiries to law firms for help with wills, which is obviously not surprising at all. And unfortunately, with COVID and the health risks it posed, many people suddenly thought actually that it was very important to sort out their wills and their powers of attorney. And in one level, that's, for us, it's great to see, because I think I do worry that many people still don't have up-to-date wills in place, or have wills in place at all. It's estimated that over 50% of the population in the UK still don't have wills in place. So it's good to see people are now taking this seriously and getting things sorted. But at the same time, trying to get a will done during a particularly difficult time at the moment can mean that it may not get the attention it fully deserves. So I've seen a definite sort of marked change in approach from my clients, where they're kind of less focused on the big questions and more focused on the immediate questions of, have I got a will? Have I got powers of attorney? If I do, can I find them? I've had many conversations with clients where they've got no idea where those documents are. And if they have got them, you know, are they still up to date? And if they want to bring them up to date, sign new versions, or just make sure they've got a will in place, create one from scratch, actually, how feasible has that been to do, particularly when we were first in lockdown and there are real restrictions around social distancing, etc. So it's been quite a stressful time, I'd say, for many families who've wanted to sort out their estate planning when it comes to their wills. So I'm just going to run through, you know, for those of you who still are on that journey or haven't yet embarked on it, kind of what would be the practical steps you need to start thinking about to move this forward. And obviously I'll focus very much on this sort of the legal aspects, and Alison will talk more on the inheritance tax side. So I'm just going to set the scene a little bit about what you should be doing first and foremost. So when we start working with our clients, it's no surprise, the first sort of job on the list is, let's pull together a list of what assets you own. And this can be quite an interesting piece of work to do, because we can find, particularly with clients who've been successful, have maybe accumulated wealth over time, that they may well have lost track slightly of what they own and where it is and how it's structured. So there's always a piece there around just getting clear on what they have. And what we try to encourage our clients to do is to look at this through the lens of, if you were the executor of your estate, what information do you need to pull together quickly to help with the probate and inheritance tax process? And we actually go through some of the detail that's required on the inheritance tax forms, because that really brings to life the level of detail that's needed here in terms of pulling together your asset schedule. So it's not just about assets you own right now, but it's thinking about, well, how do you own those assets? Do you own assets in joint names with other people, or do you own them in your sole name? Where are those assets located? Are they all in the UK or are they in other countries? Thinking about things like pension policies, death and service benefits, other things that may not be immediately obvious to your executors that you need to make sure you've got collated as a sort of a schedule of information for your executors and family to have access to after your lifetime. You also need to think about what gifts you may have made, significant gifts you may have made during your lifetime, and Alison can talk a bit more about this on the inheritance tax side, but it's always important for executors when they're completing the inheritance tax return to understand what gifts that the deceased person had made during their lifetime, and particularly over the past 7 years. So again, having trying to keep a good schedule of information about gifts you're making is also very relevant. In terms of clients who have assets outside the UK, it's really important to understand some of the complexity that can arise in connection with overseas assets. Often where you have assets in overseas countries, it may be the case that a UK will isn't able to deal with those assets in those overseas jurisdictions. And essentially, when we look at a person's global estate, we have to identify what assets they have in different countries and work out if it's sort of fixed assets, so assets such as real estate, or non-fixed assets, so assets such as bank accounts, shares, and so on, because different rules may then apply in that country as to how they pass. And typically, in most countries, you'll find that if you have a residential asset in a country or a commercial property in a country, it will tend to pass under the laws of that country. But if you have other assets, such as bank accounts and shares, they may pass in accordance with either the laws of your domicile, the laws of your residence, or the laws of your citizenship, and there's various different factors. So actually, when you start thinking about that international piece, you can see that it can get slightly complicated, and often we have to make sure we're clear on what our clients own, and then work with overseas colleagues to understand the laws in place in those countries. And then once we're clear on that, then work out, well, can we just use a UK will for some of these countries, or do we need to have local wills in those countries to deal with those assets? And if we do need to have local wills and we have a UK will, how do we make sure that those different will documents speak to each other and they dovetail together? Because sometimes people won't necessarily think that through, and there's a risk there could be conflicts in terms of the different provisions within different wills. So I just wanted to touch on that because I think it's an area that people don't fully understand, that it's important that they have a broad understanding of that. So I think when you're pulling your asset schedule together, you're starting to think this through. If there's overseas assets, engaging with advisors such as ourselves who can support you with understanding that international picture. And then the second piece is just starting to think through the values of those assets. And it's not necessary to get formal valuations of all your assets, but just work out broadly what are the rough values we're talking about here in connection with your assets, because that will indicate the potential levels of inheritance tax exposure that may come into effect after your lifetime. As I said, Alison will turn to that in a moment. But the reason that's important to do that now is because it may then influence your thinking around, well, do I want to give some assets away now during my lifetime? And if so, how do I want to give those assets away? Or if I'm passing those assets under the terms of my will, do I want to think about what inheritance tax planning I may want to implement under the terms of my will to take account of the inheritance tax laws? So again, just understanding that inheritance tax piece is really critical at this stage, which is Alison will turn to in a second. The next piece is then thinking about who could actually deal with my estate. You know, who do I feel I trust to take on this role, but also who's got the time and the willingness to take on that responsibility. And we describe these people as executors. And if you create trusts under the terms of your will, they can also be trustees. And it comes with some responsibility. As I set out here on this slide, the executors have to do a number of things when a person passes away. They have to register the death, they have to obtain valuations of the assets, they have to work out the inheritance tax that may be due, and they have to prepare the return. They then have to go through the probate process, and then once that's been finalised, they then have to actually then administer the estates. And by that I mean pay off debts, pay out any legacies under a will, and then distribute the assets more broadly in accordance with the residuary terms of a will. So there's quite a lot to do there. And obviously they can seek professional support from advisors such as ourselves or other advisors you may be working with. But still, it comes with some responsibility and some time. And so I think it's important to think through who that person should be. It's also important to think how independent is that person. If you're concerned that there's a real risk that there may be some family tensions after you pass away, then how well placed is that person to kind of deal with that and administer the estate in the right way? I have had conversations with clients when they start to think about who could be their executor, and then they worry a little bit about, well, what pressure and tensions could they have to deal with as executors, because I'm conscious that different family members may not be happy with what I want to do here under my will. So it does need some careful thought. I think once you started to think that through, the next piece is then, we've worked out your asset base. We're trying to think through how the laws in the UK and other countries may apply here. You started to get an indication of the inheritance tax liability, and therefore started to shape your thinking around how your will might be designed or what lifetime planning you may do. And then you're turning to kind of really sort of very human points here around, well, actually, who do I want to benefit here and how? And clearly, immediate family will be your primary concern. And what's interesting here is obviously, if you're married and you've got children, one of the interesting dynamics is thinking through, well, do I pass everything to my spouse, or do I want some assets to pass to my children? So often I see in connection with family businesses that they may feel that actually they don't want to pass on shares, for example, in a family business to a spouse, because that's not something the family feel is appropriate, and instead there's agreement between family that it needs to pass to children. But you can see, if the business forms a big part of that person's wealth, you need to start thinking through, well, how would that work for the spouse? Will they be left sufficiently financially independent? Will they be well looked after? How will they feel about not inheriting shares in a business? So when you start to look at what goes to a spouse, what goes to children, you have to think through some of the emotional and practical aspects that could arise there. And I think the key thing there is making sure that your spouse feels they've been left in a position where they are financially independent and they can continue having the same quality of life that they had when you were alive. Where we have children, there's often a big concern around how do we pass those assets on, particularly if they're young children. Should we be thinking about using trusts? And as many of you are probably familiar, trusts are effectively a type of structure which enables assets to be held for a period of time for the benefit of family members such as children, and for those assets then to pass to the children at certain ages or in certain circumstances. So it can create some control over how the assets pass, and can prevent the assets from passing outright to children at too young an age. So trust can be incredibly valuable. But again, as I was saying, with the executors, you need to think through, well, who would be those trustees who would take on that responsibility? And it may well be that you use a combination of people that you know and trust and like, and also some professionals like a lawyer who could take on that role with them. It's important to think through not just family actually, but who else could have an expectation of receiving something from your estate. Often one of the pitfalls with wills, particularly when somebody passes away, is that somebody in that person's family, or somebody who was a close friend or worked for that person, may be disappointed with what they've received. And if they wanted to, they could try and take legal action against the estate. They could try and claim that they were a dependent of the person who passed away, and they feel that they should have received more from the estate to enable them to continue to live the life had got used to living. So it's an area that needs to be thought through quite carefully. And so we often try to encourage our clients to think through who may have an expectation, and what could you do to try and satisfy that expectation to a certain extent. you'll never probably make everyone happy, but if you've given it some thought and you've dealt with it head on and given them some form of financial provision, then that could be a better outcome and could prevent the risk of any litigation arising after you pass away. As we've been speaking about, as I've been talking this through, sorry, you know, one key thing to think about here is, do you definitely want to pass everything under a will? You know, a will, once it comes into effect, hopefully it all works in the way you envisage, but there's obviously risks that it may not do. And so for some of our clients, they may feel, particularly for their more valuable asset classes like their business, that they don't necessarily want to pass it under the terms of a will. They may want to do a bit more lifetime planning and look at creating trust structures that I mentioned a moment ago, or creating more sophisticated corporate holding structures in which family members then have interest. So I think it's important as part of this to work out, do I definitely want to rely on a will to deal with everything? Because that may not feel a completely comfortable approach. And the last thing just on that list there is around what we call a letter of wishes. So particularly where you've got trust under a will, but even if you don't have trust, I think we encourage our clients to draft a letter from themselves which explains why they've done what they've done and how they want their wealth to provide for the family. It almost speaks from the grave. It's sort of the voice of that person saying, here is what I intended and here's how I saw things working and why. And it's incredibly important to people because it really gives that context that people may not otherwise have, because wills are very legal documents. They're not easy to understand. And I think if you have a letter of wishes, it can just bring that will to life far more effectively. They're not legally binding documents, letter of wishes. They're there to guide and support the people who deal with the estate and the family, but they are important, and it's something I think people need to give attention to, but with legal advice, to make sure that what they're saying in the letter of wishes ties into the actual terms of the will. So those are kind of the main points. I think the final point I just wanted to make really is, if you've already got a will in place, just take a look at it. You know, have a look and see what's changed since you last signed that will. You know, your children may have grown up, you may have become wealthier and have a more complex asset base. You may have got divorced, and actually if you've got divorced, your previous will would have been revoked and no longer valid. So you'll definitely need to get a new one in place quickly. But just think about those change in your life circumstances, because that may require you to update your will, or it may not. But the key thing here is just to think through what isn't covered by your will. I think when you're drafting your will, people can get quite focused on needing to be very precise and have a lot of detail in their will. And actually, in my experience, I think the key thing here is to try and keep it simple and to try and keep it flexible. You know, the more flexibility you have in the will, the better, because it can enable the family to really adapt what may be achieved under that will to meet the circumstances at that time. And it's important to note that under the inheritance tax laws, under section what we call 144, it can sometimes be possible for family members to vary the terms of a will to achieve a better inheritance tax outcome if everyone's in agreement with that. So there is some flexibility from the perspective of the legislation in that context, but otherwise drafting a will simply and flexibly and getting it done quickly is important. So I'm now just going to hand over to Alison, who's going to talk us through the inheritance tax issue. So just bear with me while I stop sharing my screen so she can now take over.
Thank you very much, Claire. Let me get onto so I can share my screen. So thank you, Claire, for that great introduction in relation to wills. And I think many times during that there was sort of mention of the interaction between wills and tax. And with the inheritance tax rate being 40% and applicable to any estates that exceed 325,000, which is the nil rate band, I think it is particularly important to be able to understand what the potential IHT exposure is for an estate, in order to make sure that you can really fully appreciate the impact of your inheritance tax position on the plans that you have to transfer your wealth and to transfer assets to your family. This is a bit of a sort of going back to some of the sort of basic principles of inheritance tax and how it sort of fits together. So apologies if this is sort of reasonably technical, but it's just trying to sort of make sure that there's a sort of help understanding of the different sort of aspects of inheritance tax and how it fits together. So inheritance tax is paid on transfers of value, not just the value of a person's estate, but is transferred on their death. But there are certain lifetime transfers that could also be subject to inheritance tax. When we're looking at how you apply inheritance tax, we are working on a loss to donor principle. And this means that we're looking at the value by how much the donor's estate has decreased, rather than looking at what the recipient has received. You may sort of think that should always be the same. You should also always come to the same answer, whichever way you go about that. But there are actually examples, particularly when you're looking at sort of sets of assets that perhaps, or shares indeed, that perhaps sort of where the donor has had 100% of something and is left afterwards with 80%, that loss of 20% is worth more than the addition of the 20% that the recipient has received. Again, thinking about sort of more international aspects, if you are an individual that is domiciled in the UK, you will pay inheritance tax on your worldwide assets. If you are, however, not domiciled in the UK and not deemed domiciled in the UK, you will only pay inheritance tax on UK situs assets. Domicile is a particularly sort of complex area, which I do not intend to go into here, but it is sort of in basic terms where you consider your permanent home to be, albeit that it can be sufficient or significantly more complex than that. So we sort of talk about it on the basis of transfers of value. So there are different types of transfers of value that I will go into in a little bit more detail on the following slides. You have exempt transfers, so things that you can pass to others without any exposure to inheritance tax. You have chargeable lifetime transfers. You have potentially exempt transfers, which are commonly known as pets. And then the bit that probably most people are most familiar with, which is the transfers on death. So I suppose the good news first, as it were, we'll start with the exempt transfers. So it may not surprise you to know that any transfer between spouses or civil partners would be exempt from inheritance tax. And I think this is where you will very commonly see the structure of wills between a married couple would mean that on the first death, most, if not all, assets would pass from the first spouse to the second spouse, and then it would only be on the death of the second spouse that more sort of detailed transfers were actually considered, and that's very much because the first transfer on the first death could be done without any inheritance tax exposures or considerations. I suspect at the moment Claire is glaring at me on the basis that may be the sort of a simple approach, which is often seen, but it's not certainly not necessarily the best approach, either from an inheritance tax position or from a sort of a general family governance position. Transfers to charities, as you probably would expect, are exempt transfers. There are then a series of sort of smaller gifts that people can make on an ongoing basis that would not attract any inheritance tax and would not be considered as part of the gifts that have been made during a lifetime. So anyone can make annual gifts of up to £3,000 without that needing to be considered. You can also make small gifts of up to £250 per annum per individual donee, and you can also make any gifts in consideration of a marriage. When we're looking at that, the level of gift that you may make is dependent on your relationship with the people getting married. So if you are not a relative of the person or a more distant relative, you can make gifts of up to £1,000. If you are making a gift to your grandchild or your great-grandchildren, you can make a gift of up to £2,500. And if you are making a gift to one of your children, you can make a gift of up to £5,000. The final category here is a very interesting one, but also one that can have sort of some potential to trip people up, if I may say so, in that you have normal expenditure out of income. So where you are just normally making regular gifts to family members or supporting family members in their life, whether that's children at university or children perhaps even after university in these days, That normal expenditure out of income, if structured correctly, could be outside of inheritance tax and outside of considerations of what is in your estate at the time of your death. So the UK doesn't have gift taxes. If you talk to people from various other places around the world, they will often ask you. We often get asked the question around whether the UK imposes gift taxes, and the answer is no. All such tax falls within the inheritance tax regime. And although there are not many occurrences where there will definitely be tax on a lifetime transfer, we do have the concept of chargeable lifetime transfers, and there are instances primarily when funds are transferred to a trust. Claire mentioned a little bit about trusts earlier. Primarily when you have transfers to trust, they would be subject or potentially subject to an immediate charge to inheritance tax at 20%. If those chargeable lifetime transfers are made within 7 years of an individual's death, there could be additional tax then due at the time of the individual's death, because the assets transferred would still have some relevance within that estate. And we'll come on in a little bit more detail to those sort of the relevance of the 7-year period, because I think it's fairly commonly talked about and is very relevant when we get on to potentially exempt transfers. So a potentially exempt transfer, or a PET as it is often referred to, is effectively a transfer that is neither exempt and is certainly not a chargeable lifetime transfer anyway. So most gifts that people make during their lifetime will in fact be potentially exempt transfers, and this is not something that people really need to think about or generally do think about until the point when you are, I suppose it is relevant when, at the point of death, because at the point of death you have to look back 7 years to see what gifts may have been made in that period. The difficulty that we have here is that none of us know when that 7-year clock unfortunately will start. So for us, when we work with our clients, we generally do encourage people to keep a record of any gifts that they are making, in order that actually at the point, sadly, when they die, you would have a good idea of what gifts had been made when you have to look back through that 7 years. Where an individual has made a gift and unfortunately has died within that 7 years, they are referred to as failed pets. And the amount of the gifts that were made are then effectively recalculated as part of the death estate, and are taken into account when considering how much tax is due on the death of the individual. Where the donor has survived at least 3 years from the making of that gift, there are taper relief provisions which do reduce the then amount of additional tax that would be paid at the time of death, between either the chargeable lifetime transfer or the PET. So you do get some relief for having survived some time, if not for the full 7 years. As I said, this does make sort of planning during your lifetime is not always as easy as it could be, because it is, as I said, obviously very difficult to predict what your 7 year or when your 7 years might start. But certainly this lifetime transfers and the making of potentially exempt transfers are very important, as Claire alluded to as well, in terms of how you plan for succession. The sort of final element of the transfers that we're looking at is then the death estate. And on death, the estate of an individual is valued at its open market value. You reduce that by liabilities of the individual and reasonable funeral costs. You are then able to reduce it further by the exempt transfers that are due to be made from the estate or may have been made prior to that. And then you look at any assets that may qualify for relief. And I will come on to in a minute a little bit more detail about one of the probably most interesting reliefs that we have, which is business property relief. The nil rate band, again, a little bit more detail on that in a second, can be reduced, but it will be set against any chargeable lifetime transfers or potentially exempt transfers before it is applied in relation to the death estate. And then when you've reached the sort of the net amount of the estate following those deductions, that is when you would apply the 40% tax rate. One other thing to note is that if 10% or more of a net estate is going to be left to charity, then there is a reduction of 10% to the inheritance tax that will be applied to the estate, and it will be charged at 36% rather than 40%. Clearly, this is something designed to encourage greater charitable giving and to encourage people to leave more of their estates to charity. Then looking at the nil rate band, as I said, the nil rate band is currently and will be until at least next year 325,000. I have to say that the nil rate band has been 325,000 for a significant proportion of my career, and it is, I suppose, as we have seen a rise in particularly property prices, I think we've seen that the relevance and the value of that nil rate band has been somewhat reduced, as certainly if you're looking in the southeast of the country, the majority of people's properties will already be taking up if not most, if not all, of that 325,000. Transfers within that are less than 325,000 are not exempt, but they are considered as being at 0%. As I said earlier, the nil rate band, there's importance of your 7 years. The nil rate band renews every 7 years. And therefore, if you made a lifetime gift of 325,000 at one point in time, you would be able to make a further gift of the same of up to 325,000 7 years later. Obviously, this assumes then that you survive for another 7 years from the making of that second gift. But some people do find that this is a very important and very helpful sort of planning tool. There's also, we've had for the last few years, we've had the concept of the transferable nil rate band, so that if in the position where, let's say, for example, that an entire estate has been left to a spouse on the first death, the benefit of that individual's nil rate band will also be transferred to the surviving spouse. That means that actually on the second death, you still have available to you the full 650,000 of the two combined nil rate bands. There's also a sort of mechanism within the transfer of the nil rate band, which means that if there were at any point an increase in that nil rate band, it would be the percentage of the nil rate band rather than the quantum of it that would be transferred, which could come in handy if there is an increase, as I said, in the nil rate band. Another thing that people may well have heard about, and certainly reflecting, as I mentioned, the increase in property prices over recent years. A few years ago, there was introduced a residential nil rate band, which was an additional nil rate band that was specifically in relation to residential property. Can't be used in place of anything else, and only applies when that property is left to direct lineal descendants, so when it's left to children or grandchildren or their spouses. This residential nil rate band is only available in full. It currently sits at 175,000. It is only available in full if the total value of the estate is 2 million or under, and at any point that it goes over that, the amount of the relief starts to decrease. Likewise, for the standard and nil rate band, any unused residential nil rate band can also be transferred onto the second spouse, so you'd be able to make use of that additional nil rate band on the death of the second spouse. So moving on to something that is slightly more, as I said, good news again. There are a few reliefs that can help in planning around inheritance tax and can help people relieve the inheritance tax burden. The two main ones that are talked about are agricultural property relief and business property relief. For today's presentation, I'm going to focus on the business property relief, which I believe, and I stand corrected if I'm wrong, but I believe is likely to be of greater interest. So it is a relief of either 100% of the inheritance tax due or 50% of the inheritance tax due, and it is a relief that can apply either during lifetime or on death. 100% will be relevant if you are looking at transferring unquoted shares, always in trading companies, or if you are a sole trader or a member of a partnership and you are looking at transferring your interest in a trading business. When you're looking at 50%, you're looking at the, I suppose, assets used in those business, whether there's a land and buildings or plant and machinery. And that always also applies when there is a transfer of quoted shares where the owner in question has control. I have to say that's one that I have never come across in practice, and is generally sort of quite a minority sport. As noted on this slide, there has been quite a lot of discussion about the business property relief rules over recent times, and certainly in the lead up to the last budget in March of this year, we had expected that the Chancellor may announce some tightening of the rules around business property relief, but in actual fact, we haven't seen those changes brought in to date, albeit that doesn't mean that the review will continue and we may see further changes in the future, which is just something worth bearing in mind. A little bit more around the conditions for business property relief. As you might expect, where you have a generous relief like this, you do have some fairly stringent conditions, and the chances are that these conditions will only become more stringent as we go forward. You are required to have owned the shares or assets being transferred for at least 2 years prior to the transfer. It's very important that we are talking here about a wholly or mainly trading business. And when we do that, the main sort of types of business that we see that wouldn't fall within that definition are generally property investment or property dealing companies. And you know, any company that is working on a purely investment basis. You have to have more than 51% of the business must be trading. If so, you will be able to get BPR on the entire value of the shares, but there may be some restriction if within that there are accepted assets or investment assets within that aren't part of the trading activity. If more than 50% of the company's activity is non-trading, there would be no BPR available at all. So it's quite a stringent rule there. You also have to be careful of what the plans are for the business at the time that you are seeking to obtain the relief. If there are plans afoot for the sale of the company and there are binding contracts in place, you would not be able to avail yourself of the relief. And finally, just to sort of point out that assets that are not part of the trade, assets that are not used, and that would include significant amounts of cash, or it could include investment properties, for example, a property that is no longer used as part of the business. Those would be excluded and would not qualify for the relief, albeit the company in its totality may have relief available to it. As I've mentioned, and Claire has also mentioned, there are many arguments in favour of looking at making gifts during one's lifetime, rather than leaving everything to be dealt with under the terms of a will at the point of your death. One slight issue here that is worth sort of highlighting, and it can catch people out, are rules that are called the gift with reservation of benefit rules, which really sort of do what they say. So what the revenue is looking for here is the circumstances where someone has made a gift of an asset, but they continue to benefit from said asset. So the typical example that we would see here is where someone would gift their house to their children, but actually would continue to live in that house without paying rent. And in that circumstance, it is actually treated as if, for inheritance tax purposes, it is treated as if that gift had never been made, and that gift remains within the estate at the time of death. As a sort of a further sort of difficulty with that is that for other tax purposes, and you always have to consider other taxes, unfortunately, as well as the inheritance tax, the transfer, the gift of the asset is still probably may well have been subject to capital gains tax when you made that, and that would still remain the case even if it wasn't considered to have been an effective gift from inheritance tax purposes. So I think that's given quite a good sort of run through, hopefully, of the basic rules in relation to IHT, and I hope has increased people's understanding. Sort of, I'd like to finish before I hand back to Claire, just to think through, I think, some of the practical considerations, which does very much echo, I think, what Claire has said earlier, and sort of lead the way into what she will say afterwards. I think it's really important to understand what your inheritance tax exposure could be if you did nothing. So if you took no action and passed your assets as you were planning to do, what would that look like? How much of your estate would be subject to and be lost to inheritance tax? Have a think about what reliefs may be available to you, and to what extent you meet the qualifying criteria at the moment. This is, I suppose, particularly directed at business property relief, and making sure that if you do hold shares in a trading business, would that qualify? Would it meet the conditions? Have you owned the shares for long enough? Is it a trading business? Are there other assets within the business that push it out of the trading qualification requirements? Lifetime gifts, I feel we may be pushing this too much, but it is definitely something that should be considered as part of any plan that is looking at wills and inheritance tax. But the thing to watch, as I alluded to on the previous slide, is the interaction with capital gains tax, because in many cases, gifts will still be considered to be disposals that are subject to capital gains tax. So they may not be a tax-free option. I do know at the moment we are seeing, asset values have unfortunately been reduced due to the current situation, and therefore we are seeing many clients that are seeing that as actually a good opportunity to make some of those lifetime gifts while their asset values are not at the level that they have been in recent years. Again, as Claire mentioned, we would, when you're looking at lifetime gifts, if it's not appropriate to make outright gifts, it may be worth thinking about the use of other structures, whether that's trust or family companies of some sort. And I think that sort of leads me very nicely back on to hopefully what Claire will be talking about next in terms of the interaction then with your will and succession.
Great, thank you, Alison. So if you could just stop your screen and I'll share mine. So we're at the final furlong now, nearly there, and just to recap, so you've sat down, worked out what assets you have. You've started to think through what the potential inheritance tax exposure could be, and as a consequence, you've now given some thought to what the terms of your will should be, what lifetime planning you might implement, and so on. And so we're now at the stage of the will's done. You're ready to get the will executed. And this, we've given you a lot of detail there and guidance, but actually you can get wills drafted fairly quickly. But I think what we're trying to get across here is, if you're going to do this well, it needs a bit of thought and a bit of time. When you come to executing a will, there's actually some quite strict rules in the UK around how wills should be executed. And so the general principle is that you need to execute your will in front of two witnesses. They need to be independent and they shouldn't benefit from the terms of your will. Otherwise, the risk is that any gifts to them will be invalid. So it's important that you kind of know, and your solicitors who would be guiding you on your will should be helping you with this, being very clear on how you execute it. In normal times, people would go to their solicitors' offices and sign the will with their solicitor and one of the assistants in the office. But unfortunately, in the current climate, and we're going to go back into this again now, that's been tricky. So there was been lots of reports, right at the start of lockdown, where people were frantically trying to get their wills done. They're trying to work out, well, how do I find 2 people to execute this because of social distancing requirements? So there's some guidance from us as a profession around, well, maybe you can execute it through a window, hand the will over to somebody with gloves and make sure that you're doing all the social distancing requirements and so on to get that will signed. So you could do it, but it was just a bit tricky. And the profession kind of lobbied the government and said, look, come on, we need to be a bit more practical here. So the government said, okay, we'll bring in some temporary rules which will enable people to effectively witness the signing of a will over video. So they're sort of recognizing the new virtual age we're living in and saying you can do sort of video witnessing, but there's some quite strict guidance around that. So for example, you need to be able to see the person who's signing the will as a witness, and equally they need to see you as a witness, and you need to clearly see that they're signing the will in front of you and you're doing the same. So there's some quite clear criteria there. And this is only for a temporary period. I mean, it's 2 years. So it's helpful, but care needs to be taken. And I think generally the profession is sort of lobbying the government to kind of bring these rules up to date, because they were brought into effect in 1837 and haven't been changed since then. And we live in a very different world now. So I think we need to try and move on a bit. Another area just to be a bit cautious about with when you're signing wills, particularly where we have clients who are slightly older and maybe have some health conditions, is really making sure that they understand what they're signing, and if there's any health conditions where they're on strong medication, that we've got some strong medical guidance that they are able to sign the document and they understand what they're signing. So if anyone has family members or they themselves are suffering from poor health and they want to get their will up to date, just be really careful around how you're signing that will, and you're getting guidance on what you're signing, and that you've got some legal advice or attestation confirming that you knew what you were signing and you had full capacity. Otherwise, the risk is that if somebody after your lifetime is unhappy with what they've not received from your estate, they could look to bring a claim against the estate, and they could bring a claim on the basis that the person didn't have full capacity and they didn't know what they were signing. So that's why care has to be taken. So I guess like the final piece here to think about is wills are great. They're so important. Got to get them into place. It's better to have a will than not to have a will. But when you're passing on assets such as family businesses, a will only take you so far. And some of the questions that I really focus on with the families I work with relate to, how do I get that asset transfer process right? How do I make sure my family are ready to take on the assets, particularly if there's a big trading business there? And so what we tend to focus on actually before we get into the nuts and bolts of the law and the inheritance tax position is actually just thinking through this broader piece around what am I passing on either during my lifetime or under a will or both, and how do I make sure my family are ready for this? And so this is an area we describe as what I commonly describe as family governance. So giving some really clear thinking to around what do I want to pass on and why? So if I've got a business and I want my family to take that on and keep it going, why do I want them to do that? And are they all in agreement that that's what they want to do? And that's really important, particularly where you might have children who aren't working in a business. So it's important they get why you feel they should take that business over and what role they should play and what support they could seek from other people, maybe who aren't family members, to enable that business to continue. So we describe that as being really clear around purpose. There's another piece here around values and actually thinking about, if we want to make sure this business is really well run by the family on a long-term basis, having some really clear articulated values as a family around how you want to manage and own this business together. And being clear around, what the business will do for the family, but also what the family should be doing for the business, and not creating a situation where the family just see the business as a sort of a money pot which they can take cash from on a regular basis without too much concern around how the business is performing. So some really clear thinking there around values. And then thinking around getting that next generation who might be taking this over ready for that future and starting to educate and train them. And there's lots of programs out there, and we run a global next gen program at PwC. So starting to think through how can you get them ready for the future. And then finally, in conjunction with all of that, thinking around, well, what do we need as a family to really enable us to communicate better, to work well together, and to make decisions well together? And so maybe you need to think about some sort of governance measures that you might need to introduce both within the business and at the family. So maybe more regular family meetings to discuss matters relating to the business, where you might involve some external people to help with discussions. Maybe having a family constitution where you set out very clearly how you as a family want to own and manage this business or the broader wealth between you, and so on. So there's various tools that can be used here. And I think for me as an advisor in this area, having done this now for a long time, I think this is a really, really important area to focus on and not lose sight of, where your wealth might be a bit more complex and you have a trading business that you want to pass on, and it's a really important complementary part of the will planning. So we've spoken there for a while, so I'm going to wrap it up there from our side, and hand back over to the team, who will take any questions and pass them on to us. But thank you very much for your patience in listening to us today. Oh, Bharat, I think you're just on mute.
Hi. Certainly, there's a lot of information that has come through, and it seems to be, some of it obviously with people who have substantial assets. There is a lot to be considered, and from the presentation, obviously there's a lot there. But I guess from the looks of it, it sounds that if you have something sizable, get professional advice to sort it out. Don't wait. Do it now. But thank you again, Alison and Claire, for spending your time with us this evening, sharing your knowledge and insights, in a complex but necessary topic that impacts all of us. And the good thing is your presentation has generated so much interest this evening that we have already received quite a few questions. And I know we are running out of time, but let's take 10 to 15 minutes and go through some of those questions. Let me start with the first one that we have received. And this question is from Komal Patel. And she says, after 75, can a personal pension be transferred tax-free to a child as an ongoing pension fund? Or will it be subject to tax or limited to encashment only?
That's a very specific question, and I have to say one area that I don't think neither Claire nor I would ever claim to be experts in, unfortunately, are pensions, because there's a lot of, I think, depending on how it's been set up. But we certainly have I know one colleague in particular that specialises in this area, so we will get a response out if that's okay. And sorry to have to pass on that one right now.
No, that's right. I fully understand that. The next question is from Mr. Umesh Raichada, and he says, what are the benefits of a trust will? And he's talking about a situation where he says, for example, if there's a joint mirror will with a spouse and would like to leave assets and properties to the children, properties are owned as joint beneficial tenants. So under those circumstances, what would the benefits of a trust will be?
Okay, there's a few little points there. So firstly, if I just talk about this point around joint ownership, because we didn't maybe cover it in depth earlier, where assets are owned jointly, and that's normally between spouses, those assets pass outside the terms of any will. So if you own your property as joint tenants, both the legal title and the equitable title, then it passes automatically to the surviving owner outside the terms of any will. In some instances, you may decide actually you don't want it to pass automatically to your spouse, but instead you want it to pass to your children. And then you may own the equitable interest, as what we describe as tenants in common. And then that means you've then got the legal ability to then decide how that interest passes. So where you've got a 50% interest in a property, that could then pass to your children rather than to your spouse in that example. So that's the first point. The second point is where you have mirror wills. What that basically means is you and your spouse are saying, let's make sure we both do the same thing here. So it could be all our assets pass to each other on our death, but after the last surviving spouse passes away, it then goes to the children. And if the children are still young at this point, when you're preparing your wills, you will probably think, actually, we want to make sure that goes into a trust to ensure that there's some control over as and when they receive entitlement to those assets. So most trusts will be designed under a will to enable children to start receiving assets from a certain age. And certainly trusts can be designed so that where you have young children and no surviving parents, the trustees can begin to make payments to their guardians to cover school fees, medical expenses, and so on. But as the children get older, they could start to receive more significant sums to buy a house, to support marriage, to pay for a marriage, and so on. And then at certain ages, they may then get more outright entitlements. They may get larger capital sums. So the idea is there's just a bit more control over how that wealth passes to the children, and it avoids the situation that they potentially get too much too young because if you didn't have a trust, effectively the risk could be that they then become entitled to everything at the age of 18. And you can see 18 is not that old really. It comes to making responsible decisions. So that may not be what the family wants.
Okay. There's one more question from Marsha Patel, and her question is, what she's asking is, what happens to inherited property from parents if you are in either, well, if you are going, either in the middle of a divorce or going to start a divorce proceeding?
So what happened? So if you're in the middle of a divorce proceedings, I'm just trying to understand that question correctly. If the question is, I'm about to sign a will, or is it more? Is the question more what happens to inherited property on divorce?
I think my interpretation would be that what she's probably asking is that, for example, if she has inherited her property from parents and now she's undergoing a divorce proceeding, how would that affect her estate?
Oh, I see. I mean, again, this is a very specialist area, and which family lawyers would typically advise on, and we turn to them. But when you inherit assets and they form part of your estate, then if you're then going through a divorce, it may be that those assets could be taken into account by the courts when they're deciding what financial award to make to the other spouse. So inherited property that's received directly into an estate may not be protected from divorce, even if you've inherited it directly. But it's a very specialist area that divorce lawyers have way more expertise than I do on that. But that's my understanding of the basic principles.
I think you answered that. I think that was her question.
Okay.
Yeah, great. There's another question from Hemal Raja, and what he's saying is, are all gifts to a spouse within 7 years of death IHT exempt? Do HMRC look into the changes in assets during the term?
So any gifts that you're making to your spouse are exempt. It doesn't matter whether they're made within 7 years or not, so they can be made at any point, and anything that is transferred between spouses will not be subject to inheritance tax. The second part of that question, I think, in terms of will HMRC look at those gifts that you've made? Yeah. There are circumstances in which the revenue would ask questions and ask the executors to give more information around what gifts and prove what gifts were and weren't made during the last 7 years of someone's life. I've dealt with a few estates where we've had to spend an awful lot of time reconstructing someone's pattern of giving by going through sort of old bank statements, which can be a very sort of painful process, which is why I will always plead with people to keep records of gifts that they're making, albeit that I know that on a practical level that's not necessarily what everyone thinks of when they are giving out nice Christmas presents or birthday presents.
Yeah, but when you make gifts to your spouse, and at the time of that, does that have to be declared on the probate forms?
I think it would be included within the information, because you would know you would need to know where the estate was going, so you would need to be able to state that was part of the exempt estate. I think that would only apply to assets that are actually held on death, not those that have been gifted in that prior 7 years.
Okay, so any assets that have been gifted in the prior 7 years do not need to be declared anywhere else, right?
Not if it's to the spouse, no.
Yeah. Okay, great. There's another question from Jitesh Samani, and he is asking, what power do courts have over a trust and the trustees?
Oh gosh, that's a big question. Okay, to answer that as succinctly as I can. So the trustees have what we call fiduciary duties, and that means that they have a responsibility towards the beneficiaries to take their best interests into account and make sure they look after the assets for their benefit. So if the trustees were to run off with the money, they would then very much be accountable to the courts, and the beneficiaries would take action against them. If the trustees were to mismanage the assets, they may have breached their fiduciary duties, and again, the courts could be called in to opine on that and seek to take action against the trustees. So trustees have to be, it's quite a lot of responsibility to be a trustee. And it's really important you understand your trustee duties. And whenever you're making decisions, you're always thinking about what's in the best interest of the beneficiaries. And if a beneficiary feels that a trustee isn't doing a good job, then they could look to take legal action through the courts to ensure that that's resolved.
I guess that would be the case, especially where the trustees are very slow in acting and, you know, passing over assets as per the will, or as per the trust.
Yeah, that's an interesting point. I think, yeah, I mean, there could be many reasons why they could be slow. But, I think if trustees are being really ineffective, what most people try to do rather than go through the courts is look to see if they can remove those individuals as trustees and appoint other people that they think will do maybe a better job. So when you're designing trusts, particularly under wills, some careful thought needs to be given to how do you appoint and how do you appoint and remove trustees, and factor that into the drafting, because often that's overlooked and that can create some problems.
Okay. And then we have a question from Prakash Raja, and he's asking, what type of charities are needed for transfers to be exempt?
For the transfers to be exempt, it would need to be a registered charity from the UK's perspective. So something that is accepted as a charity by the Charities Commission in the UK. I have a feeling that there's an extension to certain charities within the European Economic Area, but I would need to double check that, because it's quite a sort of specific rule, and I have to say isn't something that comes up very often in practice. Generally speaking, a charity that qualifies, that is a charity according to the Charities Commission, is what you're looking for.
Okay. And then I guess we have another question from Praful Takrar, and I guess he's just simply asking that is it possible to have a copy of the slides? I guess there was a lot of information to digest at one go.
I think that should be fine. I think we should be able to share the slides.
Okay, brilliant. Another question from Neha Mojeria is, does the nil rate residential ban apply to all residential property or one's main home only?
I'm pretty certain it refers to all residential property, but is probably most intended for people's main homes. Right.
Okay. And then we have a question from Pratap Bhai Khagram, and he's asking that, you know, normally if a will was handwritten and not written by a solicitor, but obviously you have your two witnesses, independent witnesses and everything, would that be legally binding in a court of law?
It potentially could be. It's something I've never seen in my whole profession, because you're just, handwriting obviously can be hard to read, and the risk is people misread something and misunderstand something. So it's always better to type it out if we can, and to make sure. And I think handwritten wills also suggest that maybe you know, there's more room for challenging what was intended and what was meant. I think if it's been drafted correctly and with some advice from a solicitor, you're in a far more robust position.
Yes. And I guess this is another question we have from Umesh Raichard, and his question is obviously on costs, as to, obviously, you know, when you go to a solicitor or even PwC for wills and IHT advice, what would the charges be? But I guess even before you answer, I can say that probably depends on individual circumstances and how, you know, complex the situation could be. But that brings to the next question, would be that, you know, if anyone wants to get in touch with you guys, Alison and Claire, is there an easy way to contact you rather than just calling PwC directly? Is there another number or email address that they could use and come get in touch with you?
Yes, we can probably put up our last slide as if we're finishing, that has both of our contact details on it, or we would be, I think, happy to share that through the network if you would like to. Before we finish, I must just correct myself, because actually the main residence, just applies to your main residence, the nil rate band extension, not to any residential property. So sorry for I have quickly checked that and just reminded myself, so I apologize.
No, that's fine. That's clarified. The other question we have is, you know, that solicitors charge quite a bit to store your will. So I guess the follow-on question would be, is there some sort of a central repository where someone could deposit their will or even register a will so that on death, the family can be notified that, this is the last will we have?
Unfortunately, there isn't actually. Again, it's something I hear debated within the profession, how do we deal with the storage of wills? But unfortunately not. No, it tends to be either you leave them with your solicitor or you keep them yourself, safely at home. But yeah, there's no kind of national database as such. I mean, it's worth noting that as a side point from that, when you pass away, your will does become a public document. So it is available and you can order it online for the very expensive cost of £1.50 from the registry. But yeah, so it does become a public document eventually, but only after you pass away and not before then.
Right. Okay. Actually, there's one question from Anonymous, it says here, and it says, if a will is written pre-marriage and originally split, well, I guess what he's saying is that the assets are split with siblings and parents. What happens to the status of the will after marriage? Is the will still valid, or what's the status then?
Yeah, just the spouse doesn't obviously get anything, and you can draft a will in anticipation of marriage. So if you put some specific language in the will which says, I'm about to get married and I anticipate leaving this to my spouse, then that can work. But otherwise, if you haven't updated it, then effectively that will is it could be valid.
Right. Okay. Actually, we have quite a, and then we will bring it to a conclusion. The next question is from Ashok Bhai Kotecha, and he says, how useful is a power of attorney?
Very, very useful. And actually, when we're supporting helping clients with wills, it's actually something we encourage them to do at the same time, as do other colleagues in the private client industry. If somebody's incredibly unwell and hasn't got capacity in the worst case, you've then got somebody who can deal with your assets. And if you don't have that power of attorney in place, you have to go through quite a laborious legal process in the UK to then have an attorney appointed. So just getting that power of attorney done at the start and gives you enormous peace of mind that if something is to happen to you and you can't give instructions, there's somebody else who can manage your affairs for you. And it's not just your financial affairs, it can be matters relating to your health and welfare. So it's an important document to do. Once you do it, that gets registered with the Office of Public Guardians, and there's a very clear, detailed form to complete. So I'd really, really encourage people to make sure they have powers of attorney in place.
Okay, great. This is the last question I guess we'll take for now. And this is from Bharat Galani. And he says, what are the implications and or tax benefits in changing joint tenancies from common to joint?
Sorry, can you say that again, Bharat? Thank you.
It's looking
Yes.
at whether there are any
sorry, this question is from Bharat. What are the implications and or tax benefits in changing joint tenancies from common to joint? I guess he's probably referring to when you change from the type of holding, whether it's joint tenancy or tenancy in common. Are there any benefits in either one?
My line's breaking up. I'm sorry. Can you?
That's what I think. It is. I'm trying to think. I think it's primarily a tax question, almost, in that it's asking whether there are any tax benefits of making that change. I suppose that if you are, if you hold property as tenants in common, it would form part of your estate at the time of your death, and whoever that share was going to would potentially there would be the value of your share of that property would fall within your estate and would be subject to inheritance tax. Whereas if you are joint tenants, it passes automatically to the surviving joint tenant at that point, and therefore would not be subject to inheritance tax. It would be a better answer for those purposes.
Right. Okay. I think we still have quite a few questions, but I think we'll bring it to a conclusion now. And if the demand continues, it might be worth having another session sometime in the near future. Who knows?
We can do it. We can do a question only session, maybe.
Yeah.
Yes, why not? Why not? But I think on behalf of Lohana Professional Network and Lohana Community of UK, I would like to thank both of you for taking the time out of your evening, to speak to us on this important topics. I'm sure our audience really appreciated this and are hopefully able to better understand some of the nuances and better understand this topic. But it's one of those things that affects all of us. None of us are kind of exempt from it. But thank you very much. And I guess before we say bye, if you want to give out your contact details as to how anyone who wants any further consultation can contact you.
Is it okay if I share? Shall I share my screen just briefly?
Yeah, sure.
Yeah.
Sure.
Yeah.
Barat, just to go back to that question about marriage, sorry, because I think I misunderstood the question. Just to make it clear, if somebody's getting married, it does revoke the will that they previously had. So I just wanted to make clear that point. And we had that in the slides as well, but I think maybe I've got slightly confused by the question that was being asked. So that was just one final point of clarification. You can tell it's late. We're all a bit tired, so there we go.
Okay, so those are the details. So if anyone of our audience, want any further advice or consultation on their personal circumstances, they're free to get in touch with, either Claire or Alison at PwC. And those are the details there. So thank you once again, and enjoy the remainder of your evening. But thank you very much on behalf of LPN and LCUK. Thank you.
Thank you very much for having us.
Thank you very much. Thank you very much.
Okay.